We're about to enter 2026, and if you're still managing your retirement portfolio with old methods, we've got a serious problem. The rules of the game have changed for retirees this year. If you want to learn which investment tools actually deliver returns and which ones are just full of promises, watch this video until the end. Now, we're connecting with David Montgomery. David is an expert in retirement planning with 30 years of experience. He's helped thousands of retirees reach their financial goals. Today, he'll be discussing the highest-earning investment tools of 2025 with us.
Hello, everyone. Thank you. Last week I spoke with a 67-year-old client of mine. The guy told me, "David, I'm retired, but my money isn't working at all. It's just sitting in my savings account." That's exactly what we're going to talk about today. If you want to make money as a retiree in 2025, your money needs to work for you, but you have to choose the right tools. Because not every investment tool fits everyone anymore. Let's discuss them one by one. Let's start with the safest option. Treasury bonds, Treasury notes, T-bills. These are debt instruments issued by the US government. The risk is close to zero. Why? Because the US government backs them. As long as this government doesn't collapse, your money is safe. In 2025, interest rates are still attractive. You can get returns between 4 and 5%. That's not bad. Especially for retirement. Because security is more important than anything. I always tell my clients, a portion of your portfolio must always be in a safe harbor. Treasury securities are exactly that. A safe harbor. Let me give you an example. Let's say you have $100,000. You invest $30,000 of it in a 10-year Treasury note. You're getting an average annual return of 4.5%. That means $1,350 in passive income per year for you. No risk, no stress. You won't lose sleep. But I must also say this. If there's inflation, real returns drop. So your money appears to grow, but purchasing power may not stay the same. Be aware of that. Now, let's move to a slightly more exciting area, dividend-paying stocks. What does this mean? Some companies distribute part of their earnings as cash to shareholders. We call these a dividend. If you own shares in that company, you receive money regularly, every 3 months, every 6 months. Sometimes, every month. It's a great passive income source for retirees. But be careful. Not every company paying dividends is a good thing. Some companies pay dividends, but their stock value drops. That leads you to a loss. My advice, look at companies called dividend aristocrats. These are companies that have paid dividends continuously for the last 25 years and increase their dividends every year. Johnson & Johnson, Coca-Cola, Procter & Gamble. Names like these. Why? Because they're stable, reliable, and they grow in the long term. Let me give you another example. Let's say you distributed $50,000 among dividend aristocrats. You're getting an average dividend yield of 3.5%. Markets are uncertain in 2025. That's why diversification is essential. Don't load up on a single stock. That means $1,750 in passive income per year for you. Moreover, if stock values also increase over time, you're receiving income and your capital is growing. This creates a compound effect, like compound interest, profit on profit over time. But watch out. There's volatility in the stock market. Real estate. Everyone loves it, but buying physical real estate isn't easy. You need capital, maintenance, rent collection, taxes. It's a headache. This is where REITs come in. What is a REIT? Real Estate Investment Trust. You invest in these companies, and they create a real estate portfolio. Shopping malls, apartments, office buildings, data centers, hospitals, and these companies are required to share at least 90% of their profits with you, by law. So you're living as a tenant, but earning income like a landlord. REITs, are particularly attractive in 2025. Why? Because as interest rates drop, real estate values rise. This pushes REIT prices higher. My advice: look at sectors like healthcare REITs and data center REITs. These sectors are growing. People are aging. Demand for healthcare is increasing. Technology is advancing. Data center demand is increasing. Example: you're distributing $20,000 among various REITs. You're getting an average dividend yield of 5 to 6%. That means $1,000 to $1,200 in income per year for you. Moreover, if REIT prices increase, your capital gains value. Of course, there's a risk. The real estate market goes up and down. But in the long term, real estate is always valuable. There's always demand. Let's get to the simplest one: high-yield savings accounts and CDs. That is, certificate of deposit. These are bank products. Their risks are very low because there's FDIC insurance, insured up to $250,000. In 2025, some online banks are offering 4.5 to 5% interest. That's not bad, especially for emergency funds or if you have short-term needs. CDs are a bit different. You lock your money for a specific period: 6 months, 1 year, 3 years. In return, you get higher interest. But if you withdraw before maturity, there's a penalty. My advice: keep your emergency fund in a high-yield savings account. It stays liquid. You can withdraw whenever you want. But if you have money you know you won't use, invest it in a CD. It provides discipline. The interest is better to... Example: you have $10,000. You're investing it in a 1-year CD. You're getting 5% interest. After 1 year, you receive $500. No risk. Guaranteed bonds. Fixed income instruments. Buying individual bonds can be difficult. You need capital. You need knowledge. But bond funds make your job easier. A fund manager buys dozens, hundreds of bonds for you. You just invest in the fund. Diversification happens automatically. In 2025, especially corporate bond funds and municipal bond funds are interesting. Corporate bonds offer returns at the 5 to 6% level. Municipal bonds have tax advantages. They may be exempt from state taxes. But be careful. Bond prices are inversely related to interest rates. If rates rise, bond prices fall. Now these risk. My advice: look at intermediate-term bond funds. Between 5 to 10 years. Very short-term means low returns. Very long-term means high risk. Example: you're allocating $15,000 to bond funds. You're getting an average 5% return, $750 in income per year. Safe, stable, predictable. This is a bit complex, but important. What is an annuity? A type of insurance product. You give the insurance company a lump sum. In return, they guarantee to pay you regular income for life, or for a specific period. Very popular for retirees. Why? Because it's like a retirement pension. You have Social Security. But it's not enough. If you add an annuity, your monthly income increases. In 2025, especially fixed indexed annuities are attracting attention. These are indexed to the stock market but principal protected. So if the market rises, you gain. If the market falls, you don't lose. At worst, you gain zero. But be careful. Annuities can have high fees. They have complex terms. If you withdraw early, there's a penalty. My advice: ask an expert advisor. Compare. Read the fine print. Example: you're investing $100,000. The company guarantees you $500 per month for life. That means regular income for 20 years from age 70 to 90. Total $120,000. You have insurance. You have peace of mind. Now, let's get to a very important point. You have 401k and IRA accounts. You've retired. Now it's time to withdraw money. But how you withdraw makes a huge difference tax-wise. In 2025, the RMD required minimum distribution age is 73. That means when you reach age 73, you must make a mandatory minimum withdrawal. Otherwise, there's a heavy penalty. My advice, don't wait for RMD. Make strategic withdrawals earlier. Optimize your tax brackets. For example, withdraw a little each year so you don't enter a higher tax bracket. Also, consider Roth IRA conversions. If you convert from traditional IRA to Roth IRA, you pay taxes now but withdraw money tax-free in the future. This can be profitable in the long run. Example, you're withdrawing $30,000 from your 401k each year. Your tax bracket is 22%, so you're paying $6,600 in taxes. But if you plan smartly, you can reduce this amount. By making smaller withdrawals some years and larger ones other years, you can balance the tax burden. This is a simple but powerful strategy. What does DRIP mean? Dividend Reinvestment Plan. You have dividend-paying stocks. Normally, these dividends are deposited as cash into your account. But with DRIP, you automatically use these dividends to buy more of the same stock. What does this do? Compound effect. Each dividend buys you more shares. More shares mean more dividends. More dividends mean more shares. The cycle continues like this. If you're 50 plus and just entering retirement, this strategy is very effective in the first few years, because if you don't need that dividend income yet, you grow your portfolio by then at 65 to 70, you start taking these dividends as cash. Example, you have $40,000 in dividend stocks. You're receiving 3.5% dividends annually, $1,400. Instead of taking this $1,400 as cash, you put it in DRIP. After 10 years, your portfolio could have grown to $56,000 just from dividend reinvestment, a slightly more sophisticated option. What is a preferred stock? They're different from common stocks. They pay higher and more regular dividends, but the share value doesn't increase much. So growth potential is low, but income potential is high. A nice tool for retirees, because regular income's the priority. In 2025, banks and financial companies are issuing many preferred stocks. Returns are between 5 to 7%, but there's risk. If the company goes bankrupt, preferred stockholders get paid before common shareholders, but after bump, so they're right in the middle. My advice, only buy preferred stocks from strong, established companies, TNT, Verizon, Bank of America, and the like. Example, you're buying $10,000 in preferred stock. It pays 6% dividends, $600 in income per year. Stable, predictable. Finally, let's talk about technology. Robo-advisors have advanced a lot in 2025. Betterment, Wealthfront, Schwab, Intelligent Portfolios. These are automated investment platforms. They use algorithms. They create portfolios based on your risk tolerance. They manage at low fees. If you're 50 and not averse to technology, these are very useful. If you don't want to do research yourself, a robo-advisor does the job. Also, there are micro-investing apps. Acorns, Stash, Robinhood. These allow you to invest with small amounts, $5, $10, $50. Ideal for starting. My advice, try robo-advisors, but don't rely on them completely. Check your portfolio from time to time. Review the fees. Example, you're giving $5,000 to a robo-advisor. The platform creates a diversified portfolio for you. You're achieving 6 to 8% average returns. Annual fee is only 0.25%. That's $12.50. That's very affordable. So what did we do here? We talk about 10 different investment tools. Each has its pros and cons. Treasury securities, safe but low returns. Dividend stocks, high income but volatile. REITs, real estate advantages but market risk. High yield accounts, safe and liquid but weak against inflation. Bond funds, stable but interest rate sensitivity. Annuities, Guaranteed income but high fees. 401k, IRA. Tax advantaged, but requires careful planning. DRIP. Compound growth, but low liquidity. Preferred stocks. High dividends. But limited growth. Robo-advisors. Easy to use, but less personal touch. Don't do them all at once. You shouldn't anyway. First, know yourself. What is your risk tolerance? Do you want income or growth? Are you thinking short-term or long-term? Then diversify. A portion of your portfolio should be safe. A portion should generate income. A portion should have growth potential. And most importantly, don't get carried away by emotions. Don't panic when the market drops. Don't get greedy when the market rises. The secret to success in retirement. Patience, discipline, and a good plan. 2026 can be a great year, but only if you make the right decisions.
There you have it, the highest earning investment tools of 2025 from David Montgomery. These insights will guide you when doing retirement planning, comparing for a 1K versus IRA options, or looking for passive income sources. If you want more content with financial tips for 50+ audience, don't forget to subscribe. See you in the next video.